So
I'm just
you'll have
starting
everything.
We're going to try without the lights on. Is that okay for you? You guys see the screen okay? All right. So just to recap quickly about the program we have for the afternoon. So first we're going to talk about the IPO process. Then we're going to have a VC panel. They talk about the corporate goals. And at the end, we have a CEO talk about the experience with IPO. So feel free again to send us some tweets or questions to there. And to start the afternoon, we have Jeff Thomas. He's the VP and head of Western Region listings of Nasdaq. So everybody's green, Nasdaq. And he will tell you exactly what you need to do. And if you do it, you can't fail to get listed and raise at least a lot of money. So without further ado, Jeff, take it away. Thanks a lot.
Thanks. So, I guess just a quick introduction. So, I know this is the laboratory hardware accelerator in San Francisco. I've had a little bit of standing to be on stage today, so I was actually an electrical engineer undergrad, so a little bit about hardware. I actually worked in semis for about 6 years before I got into finance. And then I kind of went through this long, winding path to get to Nasdaq. One of the stops, which included working in a company called Second Market, where we did pre-IPO liquidity. And I actually joined Nasdaq to help them launch Nasdaq Private Market. So that's an option that's available now pre-IPO. We've done about $20 billion in liquidity for venture-backed startups. Another quick plug for all things Nasdaq before we dive into the IPO stuff. We do have our own event space in First Howard called the Nasdaq Entrepreneurial Center. It's a nonprofit where we're the headline sponsor along with Wilson Sonsini and KPMG, and we do free entrepreneurship education. So everything from startup law, startup finance, product market fit, PR training. So for anybody that's at kind of an earlier to mid stage and looking for tips and tricks on how to be a great founder, swing by, go on the mailing list. Afterwards, we're happy to get you in there for some free education. But of course, the whole reason we do all that is to try to help people onto what I call the road less traveled when going public. Because, frankly, the number of IPOs in the U.S. is not what it used to be. Back in the 90s, we'd be looking at 400 or 500 IPOs a year. You can see on the top right there, 2014 post-Jobs Act, we had a nice little spurt of about 300 IPOs. A large number of those were biotechs that took advantage of the fact that you could confidentially file with the SEC, so they didn't have to tell everybody what drugs they were developing until they were ready to go public. Once those got out, we've been kind of, running around about 200 IPOs a year. We've had a couple high-profile ones this year, so we're actually on a good track. We've had a little over 100 in the first half year. We've got a very strong pipeline for the second half. And when you look at kind of the equity market performance on top left there, what you can see is this year, the Dow, the S&P are kind of, they're doing okay. Actually, the Dow, tripped into negative territory today based on some of the trade fears. But Nasdaq's up about 12%, which is good kind of for a gauge for the tech sector. So stocks are doing well. That's one of the reasons companies are going out. When you think about who goes public, I think out here in Silicon Valley, a lot of us think about the tech companies. Well, it turns out that by proceeds raised, that's only about a third of the companies, the money that's raised through IPOs. So 2/3 is actually for other sectors. on a deal count basis, healthcare is actually much bigger than technology. So I think we get a little bit caught up in our own little bubble here somewhere. The middle chart on the bottom kind of shows when companies go public, they issue a range. They say we're going to price our stock between $10 and $12, and then we measure do they price above or below the range. And what you can see this year, it's in tiny, tiny print, but 75% of deals have priced in or above the range, which is a really good indicator. It shows that the buy side has a big appetite. They want people to come out. And overall performance is doing pretty well this year. And another thing I think people out here kind of lose touch with, only 25% of those 100 plus IPOs are venture backed. So there are lots and lots of companies that go public that haven't raised VC money. In fact, a big chunk, 14% of the money raised this year, is for financial vehicles called special purpose acquisition companies, which are actually set up to acquire some of those VC-backed companies. So that's an interesting alternative that we can talk about a little bit later. Any questions on the overall IPO market? Any stats or numbers you guys hear talked about a lot that you want kind of demystified or anything else?
What sort of like small size or when a company that you just start thinking about?
Yeah, it's a good question. It's something we get asked a lot. I've actually got a couple slides on it later in the presentation. But for tech companies here in the Valley, so folks in this room, generally speaking, when you talk to the bankers, they're going to say you need to be at or around 100 million in revenue. Then they talk about kind of the rule of 40. So you want your growth rate and your operating margin to equal 40. So you better be growing really fast if you're losing a lot of money. And that's all to get the attraction of kind of the biggest, best investors, right? There's plenty of companies that go out that are much, much smaller than that, but those are just some kind of rules of thumb. Now, if you're growing really fast, maybe you can go out a little bit earlier. If you're growing slower, you maybe have to be a little bit bigger, but those are some good rules of thumb. Yeah?
You said 20% are VC backed
Yeah, 25% of the VCs of the IPOs this year are venture backed.
What about the other 75 to 80%? Are they all bootstrap companies? Or what?
So 70% we classify as private equity, so more buyout kind of sponsor backed. And then 58% are just either bootstrapped or, as I mentioned, they could be that would be where like the special purpose acquisition companies fall in. Financials, there's actually a lot of like community banks that go public that wouldn't have a sponsor backing. And then when you get into kind of the industrial area, then a lot of those are not kind of sponsor backed.
What about time to IPO? What do you see that?
Yeah, average now is approaching in on 10 years, especially for venture-backed companies. Back in the 90s, it used to be closer to 3 to 4 years. So it used to be you raise a Series A, and then B and C, and if you're doing well, then you get out. Now we've got companies that are waiting at least a decade till they get to that kind of steady state size where they think they can justify it. Some of the other factors that play into that, you really want to have good visibility in your model. So we'll talk a little bit about what it's like being public, and the fact that you need to be able to call your quarterly results, at least for the first year you're out. So you want to be at a very predictable stage of your kind of growth. And if you're, out there doing really big deals one quarter and nothing the next, Wall Street doesn't really love that. And then you also just want to have kind of enough revenue and profitability to pay for all this, right? There is a cost, not only to the IPO, but the ongoing reporting requirements to be a public company. Any other questions or anything before we dive in? Yeah?
So the sponsor type pie chart is breakdown by the number of deals or by the month?
That is, I believe, by the number of deals.
Do you have a sense of how the pie chart will be measured by the size of
That is a good question. Trying to think about some of the larger deals. So like Dropbox and DocuSign we'll talk about, we're obviously venture back, those were some of the bigger deals. But then like IG was like the biggest video tech company out of China, and they were spun out of Baidu, so I think they would probably fall in the other. They raised like $2.5 billion, so I'm just kind of making up numbers in case I think of that. I'm not sure, but we get back to it. Yeah.
You said if operating market's not bigger, growth doesn't really sort itself. Fast growth. So what would you consider fast growth?
Yeah, so on the rule of 40, that number I mentioned. So say you're growing at 50% a year, but you're burning 10%, then you'd hit the rule of 40. right? Say you're growing at 30% a year, but you're losing 100% a year, then you're, negative 70, that's not as good. There might be a software company that recently filed with metrics like that that's going to take a big downturn on their IPO. So, just something to always look for. And, again, when companies file to go public, as I mentioned, one of the big changes, it used to be you got to watch their whole filing process with the SEC, and you watch them go back and forth, and they fight about financial metrics. Now the rule is you have to file your S1 public 15 days before you start your roadshow. Right, so the companies that filed this Friday, they'll take the next 2 weeks to let that kind of sit. They'll start their roadshow on the following Monday, and then IPOs, for whatever reason, always price on Wednesday and Thursday nights, and then we bring the bell on Thursdays and Fridays. Just kind of the bankers' norm. So. Yeah.
I noticed there's a lot of activity on small companies going public on New York Stock Exchange. Is that the trend?
So the trend really changed pre-2009. You had to be profitable to list on the New York Stock Exchange. We did a good job of keeping companies like Intel and Microsoft and Cisco. They were always trying to take away from us. We kept them. And so in 2009, they changed their listing standards to match ours, where you could be unprofitable and go public on the New York Stock Exchange. So fast forward to today. Now every listing, especially in the tech space, is highly competitive because listing standards are not really part of that. I'd say they're generally strong in industrials and energy. If you look at kind of their overall franchise, we're very good on tech and biotech. When you kind of look at financials, we have all the small banks, they have all the big ones. So they kind of break it down. And then as you get companies, some of them will want to go where their peers are. It's a little bit funny because it used to be back in, like the 80s, there was like a desk of people sitting around phones. You've seen the movie Wall Street. And those people were broken out based on the exchange. So there were guys that traded New York Stock Exchange stocks. There were folks that traded Nasdaq stocks. And so it was very important that you listed where your peers were because that's where the traders were. Now all stocks trade in the data center and your peers. So it really doesn't matter from that perspective. So that's where the exchanges have to now differentiate on things like marketing and visibility, free service offerings around investor relations support, things like that to kind of help the company be better public. But that's been the big change. Any other questions? Yeah.
Versus US, do you see these trends consistent with Shanghai Stock Exchange and Shenzhen?
I don't track those two markets as much. We are starting to now pay attention to Hong Kong a lot. So when Alibaba went public, there was a lot of talk about whether they'd list in Hong Kong or the US. They had a dual class stock structure where Jack Ma had, multiple votes per share. And Hong Kong did not allow that. And so they ended up coming to the US where dual class stock was permitted. In today's environment, the Chinese government has exerted some pressure to say, hey, we'd really like all the large companies in China to list locally. And so now, Hong Kong Stock Exchange recently changed their listing standards to allow for this dual class stock structure. And so now all the big companies in China, especially the big cell phone producers and the like, are now starting to pursue listings in Hong Kong. So of course, that was part of our rationale when we went to the Department of Justice that said we should be allowed to acquire the New York Stock Exchange and merge the two. We said it's an international competition for listings. They said no. And so that didn't work. But now you can see it is kind of breaking down much more country by country. Another really interesting trend, again, a little off sector for this audience, but we see a lot of biotechs now looking at pursuing listings in pursuing a listing in Hong Kong as well. And so you've got, now they're starting to come up. But in terms of the changes on mainland, I just don't track those. Yep.
So do you see more Chinese companies coming to Nasdaq, or do you see what's the next total sum?
Yeah.
More coming this way or going back to Hong Kong or
We have a large number of Chinese companies in our pipeline, but I think the trend has been many of them are deciding to stay local. So we did have a couple large ones that came out earlier this year. I mentioned iQIYI. Bilibili was another big tech company out of China. So there's been a good number of them so far this year. But I think especially the larger ones are now looking to list in Hong Kong. Because I think it's that, and then frankly, it's there is always a better case to be made that you want to list your shares where your customers are, because the investors will have a better understanding of your product.
How about valuation? Is that another reason?
Absolutely. So I think, especially when you get into some of the mainland markets, I think those have much higher valuations, sometimes in the US markets. But then, the question is how deep and how liquid are those markets? So it's great if you have a high valuation, if you can sell your shares. And so that's one thing you want to always look for. Any other questions? Happy to do the whole time, just Q&A. That's all.
I know a couple of Valley-based tech companies and listed Taiwanese stock market. Talk a bit about the difference. How are they providing value?
I don't personally track the Taiwanese stock market that closely. I did look at it a little bit a few years ago. One of the interesting things that they have, in addition to private companies and public companies, they have something called the gray market there, which is largely an accredited market. So when I was at second market, we kind of looked at that as maybe a model to emulate. But when you look at any of those kind of regional stock markets, like Taiwan, I put ASX in that bucket. London has their AIM market, and frankly, it's some local LSEs like that as well. I think that you always want to look at the size of the capital markets, the depth of those capital markets in terms of the number of investors, and then just the overall liquidity. And so we generally aren't talking too much about companies that are looking at Taiwan or ASX versus Nasdaq. A lot of them, I think, will look at that as that's strategically important. That's where our customers are. Based on our market cap, that's going to be a better size market for us. And then I do talk to a lot of companies that say, okay, we've listed on one of these other markets, and now we'd like to come back and list on the Nasdaq market once they've grown kind of in size. Hope that's helpful. Any other questions? All right. Well, hopefully you guys can think of a few more as we go along. So IPOs are a lot of fun. We had Dropbox in earlier this year. I think this is one thing that a lot of people kind of think about when they see the IPOs on Bloomberg. People come in, they ring the opening bell. There's a whole process around the first trade where they're doing kind of the book build the next day in terms of what the stock's going to open at. That's kind of determines the IPO pop that people talk a lot about. You get to have all your employees there. You get very excited. We do a lot of branding, right? So when DocuSign went public, we turned Times Square yellow, part of their rebrand campaign. We had their whole management team there. They even had a musician, Michael Franti, out in Times Square playing music, kind of custom DocuSign songs. So it's a lot of fun, right? It's a party. But I think the best analogy I've heard is it's the wedding and then the marriage. Because sometimes being public isn't so much fun. So folks here in the hardware space, I chose Fitbit as an example. So they came out, a very highly touted company. This was kind of before Apple came out with this. And, they came out, price their IPO $20 a share, shot up to about 30 the first day. By August, this was in June of 15, by August they were trading over $50 a share. Great. And they were marching along. First earnings out of the gate, they actually beat revenue. I think the estimates were $319 million, and they hit $400 million in revenue. It's amazing. Gross margin slipped, though, from like 52 to 47, and that gave analysts some pause. So the stock dropped down to like $40 a share. Then for Q3, they announced and they said, and we're actually going to do a secondary offering and raise more money. And the analysts kind of said, we need money again this soon after an IPO? And then the stock dropped down again. And then they came out and they launched, the Blaze, and that wasn't super well received. There was a lawsuit, and then, kind of fast forward to 2017, they're trading at like $5 a share, down from 51. So, it's just kind of a tale. Now, Fitbit's an amazing company. They're category defining. They still sell a ton of health tech. There's a lot of resurgence recently. I think their latest product is getting great reviews. I think people see the future of health tech. They're still valued at like $1.8 billion, depending on the trade of the day. So this is still a really big company. But when you get into kind of the mindset of what does a good IPO look like, you have to think about, what do your investors care about? What do your employees care about? And what are you really talking to the analysts and the investors on the IPO side about? This, I kind of put it to be a little funny. And it kind of gets back to that first question about how big you have to go public on Nasdaq. This is a page of our listing guide. I think it's a little bit of my chart up here, but the fun fact here is, so there's 3 different market tiers on Nasdaq. You only have to do a $5 million IPO if you're profitable to qualify for Nasdaq. you can be a very, very small company, right? If you're not profitable, there's two other standards. There's the equity standard and the market value. You can have a market cap of 50 million and raise, $15 million, and you can qualify even if you're not profitable, right? So you don't have to be a big company to go public, but this is why you maybe wouldn't want to think about it. This is a page out of Nasdaq. They do a lot of great kind of small cap IPOs, and they basically walk through this analysis here where they say, look, if you go public and say it's a $100 million IPO, and they take the average, large investment management firm that's managing, $20 billion, right? And they get a $9 million allocation in that IPO, they're getting 0.045% of their fund is allocated to that. So even if you double in your first year, you're not moving the performance of that fund, right? And there's a lot of analysis that's been done as you look at it. This is why large caps are doing so much better, because you have this consolidation on the buy side where you have much larger funds. So it's tough to go out and target those smaller investors where you can have a meaningful impact. Now, the exception to this, I think, is healthcare, right? If you're going out with a life science company, one, they're very capital intensive. So the investors know they're going to come back for more and more money all the time. And two, if they do get their drugs right, and they get a big market opportunity, they can go up 10x, right? So you can get actual venture style return on that. And so that's one of the reasons why the banks are saying, wait longer, wait till you're bigger, because then you can go out and actually become a more meaningful stake to some of the larger investors that are out there that everybody wants to have. So people always say, well, why do you go public, right? And it's really these four things, right? And this, I think, is true of really any analysis of any funding source you're looking at, right? The number one reason why you do any financing is because you need money, right? So the question is, what kind of money do you want? Do you want public equity? Do you want private equity? Do you want debt? Do you want some other, interesting flavor? And so then the next three are really, what do you get from the source of that capital, right? A lot of companies will want to go public because they want to get liquidity. Well, as we talked about, you can actually provide liquidity as a private company now, so maybe that's not as important anymore. Maybe you actually want to remain tightly controlled. You don't want all your employees to sell all their stock, so doing a private liquidity event once a year is a better option for you than having the stock be freely tradable. Maybe your VCs are saying, hey, we need to get out, so you need to go public, and so maybe that's a different analysis. The second thing you can get from a funding source is credibility. So when you go public in the US, you're then submitting your quarterly filings, you're exposing your financials to the world, and so if you're selling into an enterprise, that gives you a high level of credibility. People can trust that they can see your audited financials, they know how much cash you have on the balance sheet, they can see if you're getting into financial trouble, so that gives you a high level of credibility in your customers' eyes. Similarly, to raise money from a venture firm, depending on which VC you go with, they may also provide some credibility. If you get a loan from a bank, and the bank feels like you're a good credit risk, that's another form of credibility. So that's another analysis to kind of think about. The last one, which I think is kind of unique to the public markets, and you probably don't get as much on the private side or on the debt side, is to have an acquisition currency. So if you're in a space that you think is going to consolidate, and you want to be one of those acquiring companies, and you don't want to use cash to do it, you have a hard time going out and acquiring companies for stock if that stock isn't really tradable on the back end. And so that's another good reason why you want to pursue an IPO. So, talk a little bit about the process and just kind of what it takes to go public. So, companies will often start IPO around 2 to 3 years before they are even thinking they want to go public. So, when you kind of start the process early, you want to start thinking about what's your messaging to investors going to look like, right? It's very different to go to the VCs with your hockey stick chart than what you want to say to public company investors. You do not want to have a hockey stick chart. You want to have a very conservative forecast that you can meet and beat every quarter, and then you raise it a little bit. It actually gets into the kind of this fun little game that you play with Wall Street, where you say, well, we're going to grow 5%, and you grow 6%. And then you say, well, now we're going to grow 7%, and you grow 8%. And as you kind of build that out, you realize that at the end, you're still growing kind of hockey stick, but you kind of dole it out over time. You also want to start acting like a public company. So when you're a public company, you have to close your quarters very quickly. You can't sit there and waste time. You need to be ready to stand up to heavy scrutiny. People are going to ask you hard questions. You're going to probably host an earnings call. You can start doing that as a private company. You don't have to have these kind of backslapping board meetings with your VCs. In fact, many of the large private companies here in the Valley will actually host investor conference calls where they just run it just like a public company would, and the investors dial in, and again, it's all a very close-knit circle, but they're able to ask all those hard questions. You want to start building those relationships with cornerstone investors. The IPO roadshow lasts 2 weeks, a little less. You get about 45 minutes with each investor. They're probably not going to understand what you do if that's the first time you talk. So there's nothing stopping you from bringing them into pre-IPO rounds. There's nothing stopping you from going out and doing non-deal roadshows 2 years in advance of an IPO. The one thing I always caution people is when you're out talking to investors, they have very good memories. So don't share projections. Don't share a set of KPIs unless you're absolutely sure those are the KPIs you want to live with for the rest of your life as a public company. We had Blackline come in and do an IPO lessons learned, and the CFO, a financial accounting software company, shared this interesting discussion that he had with one of his board members where he said, well, look, I really think that the number of users is critical to our success. We're like a software-based company, so a SaaS company, so they count users because they charge per seat. And so the board member said, think about that. I don't think that's the right metric for you. He said, no, absolutely. It's what drives our business. Fast forward a year later, they come out with a much higher average selling price, ASP product, that does not require a lot of seats. Their revenue's off the charts. They're hitting every metric. And every quarter, the thing they're explaining on their conference call is why their average user number is. Because they went out and told investors this is a key metric. And they see every other metric sitting in the charts, but that one's flat, and they spend time explaining it. So just an example of how you want to think about that. And then as you kind of think about assembling the right team, so, a lot of tech companies out here will go with a couple of the larger banks, Goldman and Morgan. But an IPO is not run by a single investment bank. You end up having co-managers. And an important aspect of what you get from a lot of those co-managers is who are their research analysts? How are they going to cover your stock when you're a public company? How are they going to help tell your story to investors? And that becomes a very one-to-one relationship. You want to spend time getting to know the analysts that cover your sector. One, they're going to have great insight for you on your industry. And then two, you really want them to understand your business. Same caveats apply. You don't want to overshare, but they definitely need to understand your business and your plans. And then, of course, the key thing is you want to look at the IPO as a milestone, not the end game. Most IPOs do not have secondary income. Most people are not getting rich the day they go public. In fact, most people just get a big tax bill. So be aware, 180-day lockups are still the norm. Many companies are, even looking at longer ones in some cases. So again, you're not going to get a ton of liquidity on the day of the IPO. It feels good, but you got to be in it for the long game. And so then, what does that long game look like, right? It's investor relations. So that starts pre-IPO. It means having the right systems in place to track all your meetings with all your investors, to know what they're asking about, to know what they care about. And then it gets down to the quarterly grind. I refer to being public as the series of endless quarters in front of you. And it's all about setting the proper expectations, going out, meeting those expectations, and then you have to develop a really strong, robust practice of outbound investor outreach, right? Even as a public company, just because you have equity research covering you, just because you're freely tradable on Nasdaq, doesn't mean investors are going to be out there buying your stock. Even we, Nasdaq, we're publicly listed, our IR guys constantly out there beating the bushes, talking to new investors to try to educate them. What does that look like? It means going to conferences and presenting. It means doing, again, non-deal roadshows. CEOs will tell me they spend, somewhere between 15 and 30% of their time doing investor relations, depending on where they're at and kind of their growth curve as a company. Right? So your management team is going to spend a long time, a lot of their time dealing with investors. So as you get ready to go public, it is not just hey, we're public, we get to make a lot of money, now we're happy. It's just the start of a new journey, and so it's important that your management team, your investors, your shareholders, and especially your employees understand what they're signing up for, and that the rules are going to change. So that was all the slides I had. Any other questions you guys have been thinking about throughout the presentation?
Yes, Olivia?
Actually, comment. So you're talking about professionalism of the management team and investor relations. What are your thoughts on Elon Musk his last conference call.
Elon Musk, follow you Nasdaq.
Yeah, gotta be careful. He's obviously a big client of ours. I think the market reacted to his behavior as you would expect it to. So if anybody wasn't on listening on his last conference call, he basically decided not to take Wall Street's questions. He kind of diverted his earnings call to go to effectively a Tesla fanboy who asked him a lot of really interesting long-term, 20-year questions about where he thought that the company was going to go, which, who knows, maybe that's what we should be focused on if we're investing in Tesla, because, I don't think he's thinking about things quarter to quarter. Quick sidebar, there's a group in New York called the Business Roundtable, recently had a meeting, and the day after, Jamie Dimon, the CEO of JP Morgan, and Warren Buffett, kind of the epic investor, came out on CNBC the next day and they said, we think companies should stop issuing quarterly guidance. They shouldn't be guiding people to here's how much revenue and how much earnings we're going to have each quarter, because they said it just leads to this short-term thinking. So this is the CEO of one of the biggest investment banks in the world, whose whole franchise depends on, the analysts covering the quarterly earnings call and the investors kind of trading around the quarterly earnings. So it was really interesting to see people of that caliber kind of questioning, why do you need that? We actually just introduced legislation in the Congress saying, hey, we think it's totally appropriate that companies should issue a quarterly earnings release, but they shouldn't have to file their earnings with the SEC every quarter. An annual 10K is fine for the SEC. You're still putting out all the, boilerplate legalese that you need. And then earnings releases through a press release are fine for investors. They still get the same information. We'll see if that makes it in Congress. But so there is that whole tension as well, which kind of plays into your comments on Elon, which is, are the markets too short-term focused? Right? Are we so obsessed with hitting a quarterly number? Since I work at a public company, I can tell you, it does lead to some kind of strange behaviors. If you're getting into the close of the quarter and you're like, all right, we're going to miss our earnings. Well, what can we do to cut costs? Well, that's not always in the best long-term interest of the shareholders. So I hope that's what Elon was kind of going for, was, hey, let's take a break from these boring, was his term, which is also the name of one of his companies, so maybe a little out of there. Let's talk about the more interesting questions, which is what are we doing, 5, 10, 20 years from now?
Kind of a quick comment on that. It's kind of interesting that something somewhat similar happened to Facebook because they optimized really the IPO price. Their IPO was around $60 or something, and then the stock went down. So the IPO was deemed kind of unsuccessful, whereas in fact it means that Facebook got the maximum amount of money off the table at that time. But then instead, so it was really on Mark Zuckerberg was saying, "Oh, we really want investors to be long term, so trust us, and we're going to get there." And then it dropped to $20, and then it started to affect morale on hiring and all the people that have stock options within the company, and they had actually to kind of adjust a number of things. But now I don't know what the stock is. It's like 190 or something.